Hi everyone, I'm Karan and welcome to Karan's Gyan. Today I'm gonna release a very short video on the risks that are awaiting for us come at 2022. As you know, 2021 has been a very volatile year. Volatile in the sense that market has experienced a lot of boom and bust. It has experienced a continued rally, but sudden shocks that have gripped all of our investors, and it is the fear that something bad might happen the next year as well. But also, there's an optimism that something good would keep on continuing for the next year as well. So, Bloomberg surveyed about 800 or 900 analysts and asked for their opinions on what risks are awaiting for us come in 2022. 2021 is ending in 8 days, and we need to understand what 2022 has for us. So, talking about the analysts, I must tell you that we have seen the phase of the stock market. We haven't seen a very strong busts. The analysts that have been interviewed here, the analysts that have been surveyed here, have been seasoned in the boom and bust cycles, not cycle, but cycles. That's why their opinion should matter to us because they see the market in a different way. They see the market in a way that we might or might not see in the next few years if we are able to survive the markets. So, if I talk about the survey is called Market Live Global Survey. This is generally by Bloomberg, where Bloomberg would interview different analysts. So there were about 837 analysts that took the survey, and the following were the demographics and primary job roles. If I talk about demographics, 44% were based out of North America, 37 were based out of Europe, 10% were based out of Asia, and 9% from the rest of the world. If I talk about the job profiles, 35% were portfolio managers, 15% were analysts, strategists, or economists. So we have a very broad category here. We've got people working in the money market, in the equity market, and different markets. And we also have people who come up with analysis, strategies, and economic policies, or look closely at what economic policies are being followed. Then we have traders as well. About 12% are the buy side traders, long term investors, be it institutional investors, investors, um, fund managers that are in the pension area, and 38% are from the rest of the job profiles. They can be anything. They can be risk managers, they can be hedge fund guys, they can be individual traders, retail investors. But since Bloomberg has taken the survey, I'm sure that Bloomberg would have accounted for the best available people in this market. So let us see what results Bloomberg came up with when they interviewed all these 837 analysts. So this is what we see. It says biggest tail risks for market in 2022, responses to Markets Life Global Survey. We see the share of respondents who have mentioned different keywords. The top of the list has inflation, followed by coronavirus, war, Fed, and China. So Fed and China, Fed in this case is US Federal Reserve, Fed and China, 13.5% of respondents felt that there are a lot of tail risks associated to US Federal Reserve or the Chinese policies. 26% feel that coronavirus can play a big role in causing turmoil in the markets, and 31% feel that inflation is something that we should worry about. 10% feel that there is some sort of error in the policymakers by the policymakers. About 8 to 6% blame it on Taiwan, Russia, or geopolitics, all within the same subset. 6.7% believe that it is the rates, which is basically the interest rates that could be a tail risk for the markets in the following year. Then central banks again. 5% believe that there's a supply chain issue that is going to cause turmoil in the markets. Then again, Ukraine, which is 4.7%, that again comes under geopolitics, war. Cryptocurrency 4%, stagflation, which might be a new word for you all. They believe that 2% of them believe that stagflation could be a very key tail risk for markets in 2022. Now let me explain all the important keywords one by one. So if I talk about inflation, as you can see, 31% of the respondents felt that inflation could be a cause of worry. So the risk of high inflation because central banks either fall behind the curve or tighten rates too quickly. So what is inflation? Inflation is basically, if I put in layman words, is back when I was in fourth standard, I used to buy a PET bottle or a 600 ml Coke bottle for about 18 bucks. In today's world, it's about 40 bucks. So I would say that inflation in, say, 10 years, 14 years has more than doubled. So every 7 years, like, the inflation is about, say, 60% or 50%, and which is a huge number uh, for emerging economies, especially for India. So the thing is, how do central banks control inflation? So if I talk about in a pure economic sense, inflation is when there is an increase in price levels based on more money being available in the market. So central banks have the authority to print money or have the authority to destroy money, as I would put it. So they basically control how much money is being circulated in the market. So if tomorrow central bank wants to print more money, it can cause inflation in the markets because there's plenty more money available and the buying power of the rupee or of the dollar has diminished compared to before. So if inflation is increasing, what central banks would do is they would take a hawkish standpoint. Hawkish is basically a hawk, an eagle, something that's aggressive. So they would basically pump up the interest rate so that borrowing becomes expensive. As you know, banks borrow from the central bank and lend it out to people. So if tomorrow the Reserve Bank of India says that we would lend out money at, I would say, 8%, you would get loans for 10%. If RBI changes its stance to increase the borrowing rate from 8% to 10%, similarly, the credit lines would cost any business or any consumer 12%. As a result, businesses would end up taking less amount of credit, and there'll be lesser consumption, lesser production in the market, and thus they feel that this can control the inflation by controlling the demand side of the things. All right. Whereas there's another point of view which is known as the dovish point of view, where dove is someone who's not who's extremely opposite of a hawk. So in this case, if a central bank takes a dovish standpoint, it is basically decreasing the borrowing rate. So tomorrow they would RBI can decrease the borrowing rate from 8% to about, say, 2%, and that is cheap credit, that is cheap capital in the market, and as a result, businesses would line up to take money from the banks, consumers would have more money in their pockets, and that would basically drive up both the supply side and the demand side of things, making uh, you know by thus controlling thus increasing the consumption and investments. So again, what these analysts feel is that central banks would either fall behind the curve or tighten rates too quickly. What this exactly means is that the central bank is clueless. 31% of analysts feel that the central banks are clueless. They don't know what exactly to do. They feel that either central banks would tighten up, lending rates really fast, or would loosen up lending rates too slow. Again, that is something that time would bear witness. We can't say it as of now, but central banks do have shown a lot of similar responses in the past as well, where they're always late. They're always late when water is over the bridge. That's when they step in. So again, it's something that is a very prominent risk factor. One third of the analysts believe that inflation is something that's going to affect our markets. Talking about coronavirus, well, there are no brownie points for this. They feel that Omicron, the new variant, can cause a lot of turmoil in the market, and it is already causing a lot of turmoil in the markets. If I talk about war, 23% or about one fourth of analysts feel that because of the arising Russia-Ukraine tensions and China-Taiwan tensions, there can be possible turmoil in the market. Next is Federal Reserve, which is Feds, basically US Federal Reserve. Analysts feel that US Federal Reserve would tighten interest rates too fast. Again, this comes down to inflation, where a lot of analysts are saying that there would be a policy error, or interest rates would be tightened too fast, or interest rate would not be tightened too fast. Again, a lot of analysts are blaming this on the policymakers, and that is food for thought for us. We must go back to uh, understand when have central banks gone wrong. Central banks have gone wrong in 2007, 2001, 99, and at various instances. So again, policymakers do play a very pivotal role in the markets. China. Contagion, because China is frequently cited with slower growth and housing bubble. As you know, the roaring red dragon, is no more roaring in that pace as such. The growth in China is slowing, and there's a housing crisis. Housing crisis is not actually a right word. It's a housing bubble. There is a lot of housing in China that is available. There are ghost towns with uh, with capacity of occupancy of more than millions of people, and they are ghost. Not a living soul is living there. So again, there can be a possible housing bubble in China, and this can cause contagion. It can spread across economies very quickly, because China is now a trading partner with each and every country in the world. Supply chain, cryptocurrency, and stagflation. So, as you know, there are a lot of supply chain issues going on. If I talk about cars, the chip makers. If I talk about energy, it is coal. If I talk about food, it is the shipping. Again, we must understand that supply chain issues has come up because of coronavirus. A lot of restrictions taking place, demand growing rapidly, or demand falling really fast, and supply is not able to match either when demand is rising too quickly because of lockdowns being uplifted, the supply hasn't coped up, or when lockdowns are suddenly being placed because of new variants being discovered, the supply is too much, and there is a supply chain issue. Cryptocurrency. Now, to be honest, cryptocurrency should have been higher in this analysis, because I feel that cryptocurrency is something that is something to worry about, with a lot of newbie investors getting into cryptocurrencies and thinking about making a quick buck. And that's something that frightens me. Personally, I don't recommend cryptocurrencies at all. Please do not invest in cryptocurrencies. It's not worth your time. You can say it's going to be the currency of the future. You're going to use cryptocurrency in space, blah blah blah. I might share a video on cryptocurrency that would help you understand why cryptocurrency is not a good investment vehicle for anybody. Unless you got a couple million in your bank account, sure, you can go invest in cryptocurrency. But if you don't have a couple of million, don't, stay away. Next is stagflation. Stagflation is also something that should have been a little higher. I don't know why 2% of the respondents are saying stagflation is something one should worry about. There should be at least 15 to 20% respondents saying that stagflation is something that we should worry about. But let me just explain you what stagflation is. So stagflation is basically a combination of two words: stagnation and inflation. Stagnation is something that stags. in the sense that it is not moving. In this sense, I'm referring to the economy, where the economy is not growing, employment level is not improving, there is high unemployment, and there is no growth in the economy. There is not much hiring going on. GDP is stagnant or maybe decreasing, and inflation, as I explained before, is increase in the prices of consumer goods. So if I compile high unemployment, low growth, or negative growth with something known as inflation, what does it mean? It means a serious discontentment among people, because people are not being employed, people's salaries are not being increased. In fact, it's being the same, but the cost of goods is increasing rapidly, and that is something that can cause distress to a lot of people. So I would recommend you to read more about stagflation. Stagflation has been discovered by economists in the late 1980s, where they blame a lot of reasons for stagflation coming up, such as uh, moving away from the gold standard to fiat currencies, and etc etc. You should read about it. It would help you expand your horizons when it comes to the economy. So guys, this is my analysis on the biggest tail risk of markets in 2022. You can have a look at these risks again and read about more of these things. Read about the geopolitics, read about Russia, Ukraine, read about China, Taiwan, read about how inflation and how Federal Reserve and how policy errors is a cause of worry. I don't think you need to read more about supply chain. Supply chain is quite understandable. Cryptocurrency is it's a area of study that's maybe out of your grasp, because cryptocurrency is portrayed as something else. So please read about geopolitics, policy mistakes, Federal Reserve, inflation. Follow coronavirus news simultaneously and understand more about stagflation. So guys, this is it for today, and I'm gonna wind up this video. Thank you very much and have a very nice day. Cheers.